There we are.
Good. And then I can go to the PowerPoint whenever you're ready.
Okay.
Okay?
Okay,
Through the
very good.
formalities here.
Okay, all right. We'll go ahead and call the meeting to order at 10:04. And then if we could have roll call, please.
Treasurer Kennedy,
Here, present?
Commissioner Crawford,
Present.
Commissioner Christian Bennett.
Present.
Okay.
Okay, that takes us to the approval of the minutes. So I'll give everyone a second or two to take a look at those. And then I'll accept a motion to approve them when you guys have reviewed them.
So moved.
Just a second.
Yeah, no, that's fine. Mr. Kennedy typed them, so I know
Yeah.
yes. I just wanted to take a look at these too.
We had our reorganization meeting
Yeah,
prior to the regular meeting.
yeah, we got
Yeah.
minutes for both.
Okay,
Here, yeah.
I'll second the motion.
All right, roll call?
Mr. Kennedy,
Aye.
Jill,
Yes.
and Sabrina.
Yes. All right, and that takes care of the reorganization and the regular meeting minutes from March 27th, 2025. All right, next is Eileen. Let's see if her clicker is
Yes.
working.
Oh, it's not coming up, it's.
Oh, there it is. There you
It's
are.
just a little delay. No problem.
I'll make it
I'll
on the
make
full
it,
screen.
full screen.
Oh, yeah.
Yeah, that would be
Thanks, yes.
Yeah.
Perfect.
Well, thank you, everyone, for this wonderful summer day. It's nice and cool up here, which is great.
It's better than in March when we met. That was nasty.
Yeah,
Huh?
I put that out of my mind. Living in the moment, I guess I would say. But anyway, yeah, thanks for, yeah, the time worked out fine. I think the 10 o'clock here, I know this was a little departure from our normal time, but this worked out for me as well. So wanted to get into the information we have here. Uh-oh, no, it's not advancing.
Is it delayed?
Is it
perhaps?
on?
Yes.
Oh, wait, is my,
Button down, you hit the down button.
all right, so we'll turn off, then turn on. Okay, there it goes, is the battery maybe done?
Just to get a lot of use up here.
No, that's the problem. It doesn't get a lot of
Ah,
use in it.
gotcha.
We don't know.
There you go.
So I just need to be a little,
Oh.
More aggressive.
yes,
More aggressive.
so, right, and I'm hitting the up button, right?
What,
Oh,
I'm
The
sorry.
the
Oh,
up-
down.
The
the
down.
button.
Down
Oh,
button.
that
The
might be the
down.
problem, okay, so same problem I have with the home TV remote.
Do we have any students in the audience?
Yes, exactly. So anyway, just focusing, of course, starting out with, well, really what are the big factors we're looking at here that impact the level of interest rates. You know, we have, of course, the Fed funds rate. The Fed has been on hold, as we know, all year. And it's interesting because the consensus is basically that they're on hold, not because of what is happening today, but because of what the Fed fears may happen. So, and we know two big items and gorillas are, of course, the geopolitical risk, you know, with the Iran-Israeli conflict particularly, and that conflict, particularly from a standpoint of if it were to impact the flow of oil out of the Middle East, that could have a very negative impact on the price of oil. And when we look back at some prior big downturns in the U.S. economy, they have been prefaced by spikes in energy costs. So with oil, of course, we're now in a kind of a calm period here with oil back down in the 60 to 65 price range. The market is breathing a sigh of relief. We know if the conflict were to escalate and oil were to go up to, say, $100 a barrel, that would be then a different story. Because we have to keep in mind that Particularly the area that we're talking about is that the shipping channels, the
Yeah.
Strait of Hormuz,
Oh.
coming through, and that is really where 20% of the oil supply globally goes through that path. So clearly, that is, a very important piece. And the other piece, the other gorilla, of course, is the tariffs. So we know we've been in the pause period. Pause ends in 2 weeks, for the most part, and so all of the deals are not done yet. So when we look at what has been done so far, the UK, who is close to being done, we're looking at countries such as trade relations with Malaysia, Vietnam, Mexico is supposedly close. In Canada, the trade negotiations there, the word we're hearing is that that is relatively close. We may see a deal come to terms in mid-July.
I have a question about that.
Yeah.
Specifically. Just because a prime minister or whoever announces a trade deal, it
Right.
still has to be ratified by their parliament or
Right.
governing body.
Yes. And same with then trade deals within the
And so
US
that,
too.
that takes time.
Right, but I think, to your point, when we think in terms of how the market perceives the trade issue, there's the, kind of different levels of what the risks are. And to get that first risk off the table, which is that a trade deal is not made and the tariffs that we have passed on remain at their elevated levels, could have a larger impact on things like inflation versus if the higher parties have agreed to the terms and it's going through just the legislative process. That's a lower level of risk,
Understood.
yeah. So it's all kind of probability driven, I guess we would say. The tough ones, of course, is the European Union. The thoughts there is that may be extended so that they're in the pause period. Negotiations, of course, are underway. That would be extended to not make the egregious tariff rates be effective. Discussions with India are centered around the agricultural side, particularly the U.S. wanting to have the ability to provide agricultural products that are non-GMO.
Yeah.
So that is a concern. Japan is centered around the auto industry. So that is a rather contentious discussion as well, because as we know, the Japanese automakers, the US is a big market for their products. And South Korea, who is another large market, particularly from some of the technology side, there's been no meaningful progress. But of course, as we know, they've had significant amount of changes. They just recently had, I think it's their equivalent of their new president come in. Presumably, once their new government is established and such, then those negotiations can pick back up. And the other big trade partner, of course, is China. And the pause with them does not have an end date until mid-August. And that's because it started the pause at a later date. So they were initially under a period of the higher tariffs, paused, scaled those back a bit. And so therefore accounting for that difference in timeline. So basically, what we're seeing coming out of the Fed, particularly, who of course controls those short-term interest rates, is basically a stance that they're not really looking to ease until these tariff unknowns become more knowns.
Makes sense.
So
And
that's
is
where we're
we talked about this a little
Yes.
bit prior. Had it not been for the tariffs, you think the Fed would have
Yes.
already reduced by 50 basis points?
Yes, and to that point, it's interesting, Chairman Powell has to do a semi-annual presentation update to Congress. And so yesterday was the first day of his testimony, and the folks were pretty harsh on him, questioning him
Yeah.
to that point. And basically, and I actually had it on while I was working, live streaming it and listening and occasionally, perk it up to, oh, what's he saying? And he basically admitted, yes, the conditions as we look at where inflation is today, the unemployment, the job, the labor market are at spots, if it wasn't for the tariffs, it would warrant the Fed lowering rates. So the tariffs really are the big factor that is keeping the Fed on hold. It's not the inflation, well, because it could be inflationary, but as we know, tariffs, even if they are higher, it's more of a shock to the system. It's not sustainable because inflation is a year-over-year change in prices. But in the same token, yeah, the Fed is just being very adamant that they need to have more certainty on the tariff situation in order to solidify what their next monetary path will be. But they just issued their updated forecast, their updated dot plot, which is showing us what each of the members of the committee believe should be the appropriate level of that overnight rate. And it is reflecting 2 additional rate cuts in 2025. So clearly, there still is, the committee as a whole, is of the mindset that yes, lower rates do need to occur. We just need to build in a little more time, and this is really consistent with what we saw as it relates to particularly the market's expectations as well last quarter, is that rate cuts will be more than likely pushed out into the fourth quarter of this year. So that's the environment that we're operating on. A lot of variables continuing to create what we call volatility in the marketplace, with rates, moving around based on what's happening on the geopolitical side, what's happening, of course, on the tariff side, and then, of course, what's happening on the budgetary side with the federal budget, which is under discussion, and hopefully we should have a little more clarity on that here also in the next couple of weeks. But inflation, as we look at it, it is still a little above that Fed target of 2%, but it has stabilized. Growth in the U.S. has slowed, contracted, of course. In the first quarter, we had negative growth there, and a lot of that was contributed to companies and consumers front-running the tariffs. So companies had significant increase in imports coming in with the expectation that if they could get those imports in at prices, pre-tariff prices, versus spreading them out like they would normally, perhaps in the second and third quarter. Unemployment rate has remained very low at 4.2%. And then the endpoint here, that yields have declined. Well, depends on when this statement was written, June 20th. They just declined materially. Then tomorrow they could increase materially. Again, this is where that volatility comes into play.
I have a question.
Yes.
So if the big budget bill
Yes.
gets passed,
BBB.
BBB,
Big
and
beautiful bill.
and we increase our deficit 3 to 4 trillion as a result, I want you to look into your crystal ball. This is unfair. I always ask you something like this. How is that going to potentially impact interest rates, what the Fed's willing or not willing to do going forward?
Yeah, I mean, and that is, could clearly be a factor going forward. And then again, there's a lot of assumptions built into that. The bill, of course, particularly on the tax cut side or the reductions in spending, the offset is, and again, the tax cuts, is a continuation of the tax cuts that are currently in place. But any additional tax cuts and the like, that they will spur economic growth. And so through increased economic growth will be increased tax revenue and the like to the federal government. And the objective is, the goal is, and again, assumptions are that this will then become not necessarily as negative to the deficit or require the U.S. government over time
So you're
to borrow as much. So
you're
this
s-
one scenario. The
Oh,
other scenario
yeah.
is that it's the growth doesn't occur, and to your point, then the deficit is larger, and then the debt grows. So we kind of have these two scenarios.
Right.
Generally, when we have very opposite scenarios, we end somewhere in between. But to your point, as the debt levels have increased, it's become more of a burden on the US because the cost of servicing that debt is grown,
Right, right,
particularly with higher interest rates. And so
yeah,
as the economy settles back down, normalizes more so, as the Fed lowers rate, if the economy starts to really take a downturn, rates would come down, and that would help to mitigate, reduce some of that debt burden, which helps the deficit, helps the level of debt that the US has to issue. But yeah, it's definitely, there's two sides to it.
yeah. We will
And
see.
we shall see where
Yeah.
we end, and we shall see really what the impact is, because I think of it in terms of, everything, the impact of anything, whether it's from a fiscal policy standpoint or monetary policy, takes time to filter in
Mhm.
to all of the underlying components.
Right.
And
Thank
things
you.
happen along the way.
Right.
Sometimes good things and sometimes bad things. But yeah, just a lot of uncertainty. And I think,
Yeah.
John, to your point, this is where, I think last time I had said, what we know with certainty is that there's a lot of uncertainty.
Correct.
And I think that theme continues today. And so that, from an investment standpoint, when we have these high degrees of uncertainty, we know that we have these opposite spectrums of possible outcomes, that we don't want to take a position strongly towards one possible outcome versus the other.
Correct.
Yeah.
And so that's where taking a more conservative approach
Yeah.
and having a disciplined plan,
Yeah.
and incorporating that and tilting it maybe one way or the other based on,
Yeah.
what we're seeing,
Right.
is the right path.
But I think you nailed it, and I would feel the same way. I would take more of the approach they're taking, because everything is so fluid, and we're talking from day to day. We're not
Right.
even talking,
Right.
month to month. It's like day to day. I think it's a
Right.
moving target, so.
Yeah, definitely. Yeah, so flipping on to the next page, on page 4, this is looking at what the market is expecting the Fed to do throughout the remainder of, I gotta change the page, sorry. Is what the market is expecting the Fed to do over the course of balance of 2025. Of course, we're showing the Fed meeting dates here. Our next meeting date is July 30th. The Fed did just meet last week. No change in rates as was expected. At this point, really, still, the market's expectations, which aligns with the Fed, is that the next rate cut will occur at the October 29th meeting, and a follow-up cut on December 10th. However, we have started to have some members of the Federal Open Market Committee, through speeches, start to tweak some of their language as it relates to when could the Fed start to lower rates, from stating, well, they could move forward with such at the July meeting. So starting to prime, I guess, the market for the likelihood that, yes, rate cuts are on the table, and they could happen sooner than what everyone is expecting.
Got it.
Yes. Again, a lot's going to depend on getting some certainty on some of these factors that we talked about. But to the other point too, when we look at the next page here, which is on the inflation side, we can see here, as we said, inflation has moderated. Clearly off of the highs of where we were back in the summer of 2022, when the Fed said inflation was transitory. But transitory, of course, took a very long time to become where we've had this moderate level of inflation, whether we're looking at the consumer price index currently at 2.4%, or we are looking at the core personal consumption expenditure at 2.5%. So again, the Fed has said, yes, we're on our path to lower interest, to lower inflation, removing any impact that may occur from the tariff situation. The growth picture, economic growth in the US, expected to be very slow here going throughout 2025. As we talked, the first quarter growth was negative. That was, this whole balance between the imports and exports impacting the numbers. But the economist surveys today, when we look forward, is very slow growth. Overall, about a 40% probability of perhaps a recession. We don't think that's a very high probability. If we were looking at the forecasters in general, where consensus was maybe a 70% chance of a recession or 75%, yeah, that would be a little more problematic, but below a 50% likelihood we're not concerned about that. As I had mentioned, the Fed did issue their updated forecast on not only the dot plot on interest rates, but also on where they believe will be the level of economic growth in the US economy. And their expectations are for 2025, on an annualized basis, that growth will register 1.4%, 2026, looking for growth to increase a bit to 1.6%, and in 27, topping out, in essence, at 1.8%. So definitely much lower levels than what we experienced in that 22 to 24 period, and of course, significantly lower levels than what we experienced coming right out of COVID in that latter part of throughout 2021. It's interesting, we generally think about trend economic growth for the US economy as 3%. We could say, over the 2022 and 2024 level, for the most part, we were pretty much very close to that, but on a go-forward basis, the expectations are that growth will be significantly lower. And again, to your point, John, depending on this whole budget discussion, on the outcome, and with time, we could see these numbers, of course, go either one way or the other. Labor market, this is the other side of the Fed's mandate. Unemployment rate has been very low here, currently at 4.2%. When we look at what the kind of recognized range of what is considered full employment to be, it's generally 4.5% to 5.5%. That is what the range has been historically. And so we can see here that we have been below the 4.5% level for 43 consecutive months. Second strongest record post World War II. And so clearly, when the Fed or the market looks at these numbers, they say, well, the US economy, the labor market is very solid. But we have to look a little further below the surface line, because these are headline numbers, and really what makes up these numbers. And so, as we know, the unemployment rate, one of the big pieces of that mathematical equation is the size of the labor force. So the size of the labor force is comprised of folks who are unemployed and looking for jobs. And so what we have seen even most recently here in May is that the size of the labor force decreased by 625,000 folks. So a lower denominator helps to keep that unemployment rate basically unchanged with where it has been. But from our standpoint, we see this as some warning signs that why are people leaving the labor force? Why are they not continuing to seek employment? And like one can argue, well, maybe it's part of it is due to the immigration actions, or maybe part of it is folks are retiring, dropping out of the labor force, or just the demographics. But in the same token, right, less folks in the labor force, and if we have a steady number of people who are employed, does help to keep the unemployment rate high. The job growth has not been relatively robust. The May jobs report showed that the U.S. economy created 139,000 jobs.
Right.
Now, we've been used to, on an average basis, having job growth in the U.S. economy being north of 150,000 per month. So if we have 139, and then we couple that with the fact that the prior 2 months were revised down a total of 95,000 jobs, that also is quite a large number. And so clearly what we're seeing is job growth has been relatively at a much lower rate than what it had been, but not in a combined negative territory, but certainly at a much lower rate than even what would be necessary to absorb new entrants into the job market. But there's always a good news to every bad news story, and the good news has been that the average hourly rates of folks who are employed has been rising. And so last read, I think it was at 6% annualized growth rate in hourly earnings. And as we know, the U.S. economy is, what drives the U.S. economy is consumer spending. And so folks are continuing to be, who are employed and are having rising wages, that does support consumer spending, which is a very critical piece of our U.S. economy. And I know we have talked about, we have rather this kind of K economy where we have the upper 20% of the consumer driving about 80% of consumer spending. That's the higher wage earners, and then the middle income, lower middle income, and lower wage earners represent about 80%. Are, of course, in a tough spot and driving about 20% of consumer spending. Yeah, I know. Kind of sad. So yields, what's happening here? We can see here the volatility. Clearly, looking at the 2-year Treasury and the 5-year Treasury, the variation in those yields, lots of spikes up and down over the course of this period. Coming off of the high inflation environment, we are in what we call a range-bound area here, where rates are basically bouncing around again. That's volatility from day to day, touching just below 4% to spiking up to maybe upwards of a 4.50. So again, very stable as far as the range goes, but within that range, a lot of volatility. When we look at these levels of interest rates, particularly this 2 to 5 year period, which basically represents predominantly the core portion of the investment portfolios, and we compare that to where rates were prior to the housing crisis, the 2004 to 2008 period. These are, we can say with comfort that we believe that these rates still present opportunities to be able to take advantage of and to be able to lock them in to provide that budget certainty. So from our standpoint, as we look at this in totality, clearly there's a lot of unknowns, there's uncertainty. We believe the proper course is to remain relatively, just to remain disciplined and maintain our allocation to building up those longer term investments in the portfolio and locking in these rates that we're seeing today. All right, so moving on to the investment portfolio, ended the month, so 29, just almost 30 million in cash, securities 185,000. Now we do recognize that we're in probably one of the low points of the cash of the county, as tax dollars will start to come in. When's your due date, John?
Oh, July
7/15.
15th.
July 15th?
Yeah.
Okay, so you probably are already starting to see some dollars come in.
Yep.
Yeah. So clearly, that will restore that cash balance. But again, that's something, we're all monitoring very closely. Average maturity on the portfolio is at 2.31 years. We would like to get that out closer to 2.5 years. And of course, the way we do that is we look at the maturity distribution, is adding securities out and to mature predominantly beyond the 3-year period. Today, when we look at the 3 to 4 and the 4 to 5, we have 18% of the portfolio maturing in the 3 to 4 year period and 17% maturing in the 4 to 5 year area. I know those numbers aren't showing up on the screen because of the font colors, but on the printouts, they are there. And we balance that with, of course, having monies maturing within the 0 to 1 year area, which today we have 22% of the portfolio, which is a little over $40 million maturing in the next 12 months. The weighted average yield in totality on the portfolio is at 3.58%. On a go-forward basis, simple math, shy of 185 million invested at 3.58% will generate annual interest income of 6.6 million. And of course, as we know, we have lots of low-yielding investments, securities in the portfolio which were purchased during different interest rate environments, which are rolling off. And as we're reinvesting in this higher yield environment. But today, so far through May 30th, the interest income for the county has been just shy of 2.5 million, so making good progress towards, where we would expect to be for 2025. Just want to add to this next quarter, we have 6.4 million maturing. And the securities that are maturing had a weighted average yield of 3.73%. And that yield is probably a little high because we do have what we call commercial paper, which shorter term commercial paper, which I purchased, that is rolling off. Now, we will, of course, look to put those funds out longer term if we feel that that's the timing as far as this volatility in the market is right. If not, we may still take advantage of some short-term commercial paper. Having flexibility is key in this environment, for sure.
Yes,
Yeah.
exactly.
So the next page here is the purchases that were executed over the past quarter. So as we can see, predominantly U.S. Treasury securities, if we look at the maturity dates, longer term, in that beyond that 3-year time period. In addition to that, we did pick up 2 pieces of commercial paper, shorter term, and there's a story behind them. What we did to make those purchases is we did what's called a swap. So we had Treasury securities that were maturing inside of a year. And we were able to realize gains on, sell those securities prior to maturity, which is permissible under the county's investment policy. Realize gains, we actually realized $106,000 worth of gains on just under $3 million of securities that were sold. And those items that we did sell were yielding, had yields of 3.95%. We were able to reinvest those funds in commercial paper to basically the same maturity date. And you can see we went from yields of 3.95 to 4.32%. So recognizing we identified an opportunity within the marketplace where we were able to do a swap from one asset class to another while keeping our, what we call our duration neutral. So we didn't reposition the portfolio. We know we need to keep monies maturing inside of a year. That's the prudent thing to do. And we were able to maintain that structure. All right, projected interest income. This is the securities only, so this does not include monies that are in Star Ohio. So what we're looking at here is, of course, we have the 2024 actual kind of as our base case comparison to really be able to see really what has been the benefit of extending the portfolio and locking in those higher yielding securities out longer. And so when we look at the 2025 and 2026 projected income, and again, this is assuming, this does not assume any reinvestments. So this assumes just, this is securities we have today, this is the income that those securities will generate in each given year. And so we can see that the income for 25 and 26 at a minimum would just be a bit above $6 million. And then of course it drops off in 27, 28, 29, and 30. And that's because as we look at the maturities falling off, that accounts for the drop. So clearly as we're adding, reinvesting out longer term, those out year buckets will continue to grow. But I think even the fact that we have 2027 investments positioned to generate $5 million worth of income also demonstrates really the benefit of, again, locking in those maturities longer. So here's our favorite part, the historical view. I think I need to take off those top 2 lines. It's depressing. The portfolio is over 5%.
Yeah, worry.
But no, all joking aside, right, as we can see, we talked about, different interest rate environments. That becomes very apparent here when we look at the yields of the portfolios, the very lean years on the portfolios. And then, of course, the periods we've had here since 2022 of really building up the yield on the investment portfolio, and the objective of having that yield, i.e. that income, be sustainable for longer. And we certainly hope we never have conditions that put us back to those zero interest rates.
Yeah, barely touching 1%, I remember.
Right, exactly, yeah. All right, so the last part of the presentation is just the portfolio holdings. This is part of the position statement we call, which is part of the monthly statement that is provided to the treasurer's office, which provides all of the detail of the county's investments. So this is really into the weeds. All right, any questions, any comments before we move on to John's part here?
You've been great as usual.
Well, thank you.
Thank you for looking into the crystal ball and telling us that everything is going to be okay. I'm quoting you on that.
Yes, it always will be.
All is good, all is well. Yeah.
Okay. Does anyone have any questions for Eileen? If not,
I do know.
we'll go ahead and move to John with the GrowLink update.
Yep. So the quick update on this is one of the things that we've talked about the last couple of these meetings is the need to really push and promote and get the word out about GrowLink and why it's a great opportunity for residential loans at 1 to 3%. I know it's usually 1%, below market in terms of the loan. And then we've got the business loan as well. So we've got a couple to report that have been new since our last meeting. We've got a trucking company to purchase a dump truck. And we've got another business that is using it for a remodel at $180,000. And then we've got a couple that are pending in terms of residential, and they're now in the process of working with Portage Community Bank, both of these individuals listed here, and hopefully that will translate into a real loan. But again, and I've repeated this before, one of the things that the uncertainty surrounding the economy and the bankers that I've talked to, Portage Community Bank, have said and confirmed this, that people are still hesitant regarding taking out a debt instrument right now, given the uncertain climate. And they were waiting to see if the Fed was about to make another move. I do like seeing the increasing interest amongst residential folks considering a loan. But I'd like also to see more businesses jump into this. So I'm hoping that in July, August, let's say the economy starts looking it's a little less volatile and the market is responding accordingly, and the Fed signals that in fact they are going to reduce rates in July, that could make people more, that could grow the appetite, I think, for folks out there who have been put all this stuff on pause. But I continue to talk it up and promote the hell out of it. And I know Joe, when he comes on board in September, he'll take up this cause too, because it is such a good deal for our folks. It's a nice opportunity for people to take out a debt instrument at a lower price point than what they would get. So, and it's good for the community. When we know that when this money is put out into for homeowners and especially for businesses, that money recirculates throughout the county, and that's a good thing for all of us. So.
Did we say anything in the agricultural realm? I know we had expanded the GrowLink
Yeah, and it's a good point. I have pitched this to our farmers as well, but there hasn't been a bite yet on that. But I am a member of the Farm Bureau, and I know they're going to be having an upcoming meeting here over the summer, and I'm going to bring my brochures again and tell them, promote the hell out of the GrowLink program.
Because right now, we only have, $485,000 left to
Right.
lend, right?
That's correct. And as you know, all it takes is one or two loans to kind of drain it.
Right.
Mhm.
Yep.
Yeah, that wouldn't take
Yep.
much, right?
Yep.
And how do you see, some of these term loans are like, it varies, but are people?
Mostly
making their-
mostly
Yeah.
5-year.
Mostly five?
Yep.
Okay.
Yep,
And are people able to make their monthly payments?
they are.
Okay.
Yeah, and here's the thing with, and Joe will learn this as well, is we don't evaluate someone based on, their loan application. We look at the broad parameters of, are they a resident? If they're a business, are they operating in Portage County? But it's the bank itself who makes the final determination, of course, as to somebody's credit worthiness.
Right.
We don't get into the loan game in that
Yeah.
regard.
And they get the extra 1%, right?
Correct.
Mhm.
So
Yeah.
I guess to Jill's question is, I'm not seeing the repayment,
Yeah, that's what I
the
was
balance,
looking
how
for.
much, it looks like
Yeah.
this is what we have left of the 3 million we've set aside.
Right.
But where are we at as far as repayment? Because
Yeah.
that should be revolving, shouldn't it?
Yep,
It goes
yep,
back
yep,
into it.
Yep, yep.
I would be interested.
Yeah,
and
I
maybe
can
you
get that data. I can.
Yeah, that would be important to us to know. Because I know over the years, we started out with 1 million and we're now up to 3 million. So, but obviously people are using that.
Yep.
So
I can follow up with all of you with details on what the repayment has been.
Because
So,
you
you
really
know,
should have more in
as
there
these
than
mature.
the 485, 150, 13, right?
Right, because that's just off the initial,
Yeah.
amount of 3 million, but some
Yeah.
of that's been repaid.
Right. And we did just get a payment back. I will calculate all that out with Jamie in my office, and I'll get you guys post-meeting some details about what we have in and what we got back from the bank.
Yeah. I just be curious,
just-
because then it can keep,
Yeah.
and the whole idea was to keep the program,
Recirculating it.
Going.
Yep,
yeah,
yep.
okay. All right. Is that it, John?
That's it.
All right, I don't have any other questions. Jill?
No, I do not.
John?
I do not.
All right, not hearing any. I'll make a motion to adjourn. Do I have a second?
A second?
Okay, roll call, please.
Sabrina,
Yes.
Jill,
Yes.
and John.
Yes.
All right, and our next meeting, when is our next meeting on the agenda? Do we have that?
The next meeting is gonna be scheduled for,
September 25th, 2025,
and it's gonna be at 11:30.
and it's gonna be at 11:30. And it's here in the Commissioner's Boardroom.
Yep.
That you can stream in as well. Okay, we're all set.